Hey guys, welcome to our podcast here, Finance at the Moment. My name is Krish Kawle, and I'm currently a junior in high school, aiming to pursue the business field. Now, we'll be making episodes like these roughly around every month or so. But yeah, stay tuned for more. Let's get started. So, as of right now, it's March, and March is always one of the rough months for everyone, but there's a lot happening during this time. At least for us students here, like I said, I'm a high school student. For us students here on the East Coast, uh, yeah, there are no long weekends or any other, days off, like where any times where the school closes in March. So it's a long month for us. But we also got big things like March Madness, which has been going on for a lot of stuff. But this year, things have been different with the financial sector being rocked to its very core with the collapse of three major banks at the start of March. It was considered one of the worst financial disasters since the Great Recession of 2008. And I think with this podcast, I want to dive into what was the cause of this fiasco and what we can learn from it. But first, I want to talk about a couple of things about the finance system, how banking works, just for the new viewers here who are a bit new to the way things work with, finance markets and the banks and stuff like that. So first, let's start with how money is stored in the bank. Obviously we have customers, who have their own jobs, who are earning income in some way, who are depositing what they have earned into bank accounts. But what happens with that money? No one really bothers to ask, what happens exactly, and why is it that we get paid interest for keeping our money in these banks? The reason is banks are paying interest to us as a form of payment for allowing them to use our money to do different things. What exactly do I mean by that? Well, when we store money in the bank, it's not entirely left in separate accounts for the rest of time. The way it works is banks, first of all, do store a portion of what you have deposited in reserves. And what reserves are is basically, like I said, they keep a certain banks keep a certain portion of what you deposit, and the point of doing that is so that if a customer ever wants to withdraw some of their money, the bank at least has some cash on hand to provide to the customer. We used to have this by law where the Fed kind of set a certain percentage to have banks, legally store that amount of money from deposits and never touch them for anything else here. But now we have shifted more to a different system where instead of the Fed mandating that the banks have reserves, the Fed pays interest to banks for having reserves. So the more money the banks keeps in reserves, the higher the interest the Fed pays to these banks. So it's sort of the system now is sort of incentivizing banks to have a reserve system of money. But yeah, anyways, typically this reserve portion is like a very small percentage. For example, 10%. So then that means that banks have 90% of whatever money you have deposited to do whatever they want. And typically these banks will either loan out that money to other customers, to hand out loans. That's where the loans come from. That's where all this money comes from, for loans. Or they can keep it in investments such as bonds. And speaking of bonds, let's talk about those here. So bonds are typically one of the safest investments that banks like to go for. And it's typically because the process with bonds is pretty straightforward. You pay a certain price, then your money is kind of used by the government for a certain amount of years, and then you can come back. You can take that money back after a certain amount of time with interest. So that's the basic idea. But let's dive in a bit more with what they are. Basically, bonds are just another type of loan, except we, consumers, banks, or other businesses, we are the lenders, lending our money to the borrower, which is the government. So the government kind of uses bonds as a way to fund for public services and other projects if they, if taxes and other sources of income, sources of revenue for the government are not enough to cover those costs. Typically, we buy pieces of paper, and they're what they're called bonds. They're basically pieces of paper where they'll have a sort of price imprinted on them, which is like the face value. And typically, we would pay this face value amount. It may be $5, $10, $20, whatever it may be, and then we get that bond. Then we keep this bond for a certain amount of time, such as 5 years or 10 years, and this is called holding the bond till maturity. After this maturity date has passed, as in you've kept this bond for the certain amount of required time, you can go and reclaim your money, and you get paid back with interest. And this interest is often called your rate of return. So as you can see here, bonds are pretty straightforward as compared to some other riskier investments, such as investing in stocks or maybe crypto. We'll get into that later. Now, as with stocks, we have this market where you can buy, sell, and exchange your stocks or shares of companies to other traders and other investors. And just like you have stocks, flowing in that sort of manner, you have bonds where there's a certain market where you can buy or sell or exchange your bonds with the bonds that other traders might have as well. And this is where the bond prices start to fluctuate a lot, because it all depends on what is the interest rate, what is your rate of return with that bond. Simply put, if I have a bond where I've paid $100 and I have a 2% interest rate on that bond, if I have to trade it for a bond that has a 4% interest rate that you bought at $100, well then that bond with the 4% interest rate, that's going to be the one that's more in demand compared to my bond. So what exactly can I do? While I know that other traders wouldn't want to buy my bond at a lower interest rate when they could just get one from the government. So the only incentive that I can offer is I can sell this bond at a lower price, a price lower than the face value. So if I bought this bond at $100, I may have to sell it for $77 or some price lower in order to be able to get my bond to be sold, and so I can get another one here. And so as you can see here, the higher the interest rate is of a certain bond, the lower the bond price drops. So you can see that these fluctuations kind of change inversely to each other, because as the Fed is rolling out new bonds with higher and higher interest rates, the previous bondholders have to sell their bonds at a lower price in order to incentivize other people to buy their bonds. They'd rather just take out a new bond from the government with this higher rate of return. So yeah, key thing to remember here is that interest rates and bond prices fluctuate and they change inversely to each other. Next, I want to go into cryptocurrency. And it's basically just an online kind of currency. It's not backed by any real fiat money, or it's not backed by any government money. That's basically it. So as a result, cryptocurrency industry, it doesn't have that much government interference with it, which has its positives and negatives here. These markets rely on blockchain technologies, which is these huge databases that are constantly recording these financial transactions happening many, many times a second, and they store these recordings as blocks here. Now, since cryptocurrency does not have any real backing to any real money, it's up to the consumers with how much trust they place in these markets, because the prices of these crypto shares are a bit more sensitive, meaning their prices are extremely volatile, and you'll often see that major cryptocurrencies such as Bitcoin or Coinbase still dramatically fluctuate up and down, more dramatically than other investments such as stocks. And once again, because of this lack of government influence here, cryptocurrency serves as a convenient way for a front for many money schemes such as money laundering here. So as you can see, bottom line, cryptocurrency, it's just a much more riskier investment than other investments such as stocks or bonds. but this does play a key role with the collapse of some of these banks here, so I wanted to go over that. Finally, I want to talk about money insurance. When you deposit your money in the bank, a certain portion of it is guaranteed, is insured by the FDIC. So what does that mean? Well, let's say I store $125,000 into a certain bank. If, God forbid, the bank ever closes, the FDIC has guaranteed that they will pay back to the first $250,000 of whatever money I stored in that bank. Now, obviously, I've stored $125,000 in this bank that has closed, so I'll get the full money back. But let's say I go beyond that and I store $1 million. Well, that means that if the bank does close, I'll only get 250,000 of what I've deposited, and the rest of that 750,000 is, it's up in the air. That is up to me. But anyways, that is how money is insured in the United States, and it was built as a way so that consumers can, it was built as a way to restore the faith in the banking system and get consumers to put their money in the bank right after the Great Depression, which is where a bunch of banks closed. It was a major crisis. But anyways, now that we've gotten these topics covered, let's talk about the collapse of the three banks. So, start of March, within a span of less than a week, we're talking 4 or 5 days, three major banks closed. We have Silvergate, we have Silicon Valley, and we have Signature Bank. And let's dive in with what these banks were and how they failed in the first place. So first, to start with Silvergate Bank. Unlike major banks such as Citigroup or Bank of America or JP Morgan, this was a bank that served for a very niche set of customers. It was specifically used for cryptocurrency storing and dealing. They sold a lot of cryptocurrencies for a fee, and basically Silvergate just saw a gap in the market where there has to be a bank to manage all these crypto transactions, and they took it and they did well. I mean, they had major customers such as Bitcoin, FTX, or Coinbase, many more. And specifically with Bitcoin, Silvergate would frequently loan out some of its assets to customers in terms of Bitcoin here. So you can see that it was heavily relied on the value of crypto shares. But as you might know, cryptocurrencies are typically very price volatile. So if they lose a lot of value, which they could in the span of a day, then that's going to hurt the bank a lot. And things were incredibly worse because we saw a crash in the cryptocurrency industry. I mean, we saw Bitcoin lose at 1.70% of its value, and then you have the closing of FTX, which is a big deal in the cryptocurrency industry, with the CEO, Sam Bankman-Fried, now being tried for fraud. So the cryptocurrency is just rapidly falling like crazy, and the value of these cryptocurrencies is declining at a rapid rate. And so because of this lack of trust, as you might know, Silvergate's customers would want to pull out their money and try to avoid getting further losses with their assets. So there was a bank run where these customers were withdrawing a lot more than what Silvergate could handle with whatever money it had in its reserves. And so Silvergate was forced to liquidate for huge losses. And that's when, on March 8th of 2023, Silvergate Bank announced its closing. So pretty rough start to the month, but the crisis is far from over, because then we have the infamous collapse of Silicon Valley Bank. Now, this was the bank that kind of made more headlines, more often than Silvergate. But this kind of failed for a completely different set of reasons. So Silicon Valley Bank, like Silvergate, also served for a particularly niche set of customers. But in this case, it was a bank for the tech industry, all of the Silicon Valley companies there. So you had tech giants like Google or Apple investing their money and storing it in Silicon Valley Bank. And you had also money from tech startups stored into Silicon Valley Bank. And you also had venture capitalists who are funding these startups also storing their money to Silicon Valley Bank. So you can kind of see, kind of get an idea of what kind of customers SVB was dealing with a lot. And, they saw a gap in the market, just like with Silvergate. They took it and they made billions. They were doing extremely well. I mean, at one point, they were ranked the 16th biggest bank in the United States. But their undoing was caused by a misjudgment with their with their investments in bonds. So, as I've mentioned before, bonds are one of the safest investments for banks, but they're not entirely risk-free. There are risks that, interest rates could rise and your bonds could lose value. And that is exactly what happened, because around 2021, SVB bought $100 billion worth of bonds, and, they're keeping it to maturity, and they were taking a huge bet that the Fed would not raise interest rates and therefore decrease the value of their bonds. Yet, however, we know that this is completely backfiring, because post-COVID, we see a huge spike in inflation. I mean, price levels are just climbing and climbing at an unprecedented rate. So the Fed has no choice but to raise interest rates to slow down this inflation. And even as of right now, just recently, Jerome Powell had announced that they're still going to raise interest rates by another 0.25%. So, interest rates are still rising. And now, as we've mentioned before, bond prices change inversely with interest rates. And because interest rates are rising, the bond prices, the bond values of the precious $100 billion bonds that SVB bought, they were losing value like crazy. And things only get worse, because you also see the tech startup industry was slowing down, with less venture capital being poured into these startups at all. So what does that mean? Well, it basically means these banks were getting lesser and lesser deposits as time was passing. And at the same time, due to the inflation crisis, businesses and other customers had to pull out their money to be able to keep up with these higher price levels and sustain themselves. So you were having less deposits, but more withdrawals. And as a result, SVB had to liquidate some of its assets at huge losses, especially with its bonds, because they were unable to hold them to maturity. Like, they had to sell them immediately just to be able to reap some sort of value back and be able to meet those withdrawals. And they were doing it with huge losses, billions of dollars in losses. And eventually, a group of investors had leaked these financial hardships, these financial struggles with the company to the public. And as a result, that just completely shattered the confidence in Silicon Valley Bank. And we see customers rushing in, withdrawing their money at an unprecedented rate, causing a bank run. And that just spelled the end of SVB, when on March 10th of 2023, we see the FDIC seize this bank and officially shutting it down. But as you might know, the crisis still doesn't end, with Signature Bank being the next victim of this crisis. So Signature Bank was an old bank, but recently they started following a business model similar to that of Silvergate, where they were also providing cryptocurrencies as well. It was the next hot thing at the time. So jumping in on the cryptocurrency craze was just, it was a no-brainer. And, they were making money off of it, and they were doing well. But once again, we had the cryptocurrency that was crashing due to FTX closing down and other, cryptocurrencies losing value. But ultimately, the final straw was when SVB was failing. Because after Silvergate and Silicon Valley had failed, that's two banks closed. So as you know, at that point, customers don't have any faith in the banks, and they don't want to keep their money in the banks. So that led to another bank run for Signature Bank, which was ultimately too much for them. They had to liquidate, and on March 12th of 2023, the FDIC had to seize Signature Bank, and it was announced that the bank would close down. So already within just the span of 4 days here, so like March 8th to March 12th, 4 days, less than a week. I think a little over half of a week, but still, extremely short amount of time, you have 3 banks closing down. So extremely bad here. And the thing that makes it worse is about the money that's locked into these banks. Because customers who have deposited these hard-earned savings into these banks, their money may their money that's stored in these banks now, no one knows where is it going to go and how it's just going to go back to these rightful customers. And while some people are thinking that, hey, the FDIC, that's why we have set up this insurance plan here where the FDIC has to pay back $250,000 of that money to the consumers, it's just not enough. Because with these banks, and in particular with the stats for SVB, we had depositors storing millions and maybe even more money into these bank accounts. Obviously, that's way more than the $250,000 insurance limit. And ultimately, what ended up happening is 95% of the money stored in SVB, and we're talking trillions of dollars worth of assets of money stored in SVB, 95%, more than 95% of that money was uninsured. So all that money, billions and billions, billions of dollars, uninsured, up in the air, no one knows what's going to happen to it. And that's the big thing here, right? So like now what's going to happen? No one's not sure. We'll have to find out, as these consumers are most likely going to have to attend the bankruptcy courts and settle out how these debts are going to be paid off, what assets are going to have to be sold, and a bunch of other things like that as well. Now, anyways, in the aftermath of this chaos, we see the stock prices of major banking institutes plummeting heavily, especially those of Bank of America or JP Morgan. But more importantly, because of this, complete lack of faith in the banking system, we are seeing other banks starting to suffer a similar fate to the three banks mentioned above, especially with Credit Suisse and First Republic Bank. But luckily, other banks, such as, I think, UBS and even Bank of America, they loaned out some of their money. They loaned out some of their money to First Republic and Credit Suisse, and that is what ultimately saved them from collapsing. And now we're seeing the case where UBS is going to buy Credit Suisse, and First Citizens will buy SVB. And as for the FDIC, the good news is they're going to step up and go beyond their $250K limit. And they've stated in a statement that they'll cover 100% of the money that was stored in SVB and Signature Bank. Now, what can we learn from this? Well, we can learn a couple of things. I think a big thing we can learn is to not keep your eggs in one basket or just rely on one single thing, like having a single point of failure, because, that applies to both the banks and consumers, because we see how that turned out. I mean, with all three of these banks, they were serving very niche markets. They weren't serving a general market with a variety of different customers to protect themselves from when an industry might crash. And because SEB was specifically suited more towards the tech startup industry, and Signature Bank and Silvergate were more tailored towards cryptocurrency industry, if these industries ever took a hit, it just meant it would hurt these banks like crazy. And that is what happened here. And that was like part of the reason why they were collapsing. But another thing is, we see SVB betting $100 billion worth of their assets into just one type of investment, which is bonds. No matter how safe they are, things could still happen. So it's always good to diversify your investments. And as you can see, SVB did not do that. They, misjudged what's going to happen to the bond prices, and that led to their demise. But finally, we have the depositors storing their millions of dollars into these bank accounts. I mean, going beyond that $250K limit is a big risk in case the banks are closed down. Well, then all your money is just all that money that is not within the first $250K. That's uninsured. You don't know where that's going to go. And so what these depositors should have been doing is storing their money in different banks, storing it, diversifying where they were storing their money such that it stays below that $250K limit and their money is still insured. So yeah, as you can see, we were betting on betting all our eggs in one basket. That's not good, and that's kind of what led to this perfect storm of mishaps in this financial crisis. But anyways, are we out of the woods yet? Definitely not. I mean, we are as stated by many news organizations, we've just suffered from a crisis that is, such a terrible crisis, so bad since the Great Recession. And if it's taken a year to just recover from the Great Recession, certainly expect it to take a year or maybe even more to recover out of these major closings. But anyways, that's all. That's about it, folks. Hope you enjoyed this podcast. We'll be uploading more podcasts, more episodes like this around every month or so on YouTube and Spotify. You can check us out there. And yeah, thank you for listening. This is Finance at the Moment, signing off. Take care.